start with, I thought let us have some context about this presentation as to what all we'll try to see, assess, and discuss now, because there could be already we could have done so many things. As I told, many other seminar sessions would have happened in the related area. So this setting up the context should be very good. So firstly, this is the first of its kind of situation what we are facing that we all know. No, there is no parallels. Of course, there are some comparatives with earlier situations, earlier crises, financial crises, and political, geopolitical crisis. But yet, this is definitely first of its kind in terms of its length and breadth and the impact which is it causing and going to be causing. And then all of us are equally ignorant about the situation because what is the real depth and breadth of the issue? When we talk about the valuation, we need to know as to, firstly, we need to know what we are heading to. Other situations with which only we would be able to draw inference on valuation. And in the process, so we'll see about the market economy, India and some other. And then let us try to draw analogy on some of the previous crises or maybe one of the previous crises. And then let us see how the investors are looking at it, in what has changed in the last 1 month, if in the recent past. Not very big ticket deals, possibly mid segment or VC and PE deals. We'll see, because most of us would be doing valuations of. And lastly, we can.
There is a lot of disturbance. Sorry, there's a lot of disturbance from your voice. It's breaking continuously.
Oh,
at least for me, and few people in the chat also has.
Okay. Let me try change my network to. Let me change my network and see 1 second. I think I should first.
Yeah, actually, there are some suggestions. Everybody should close their video. Then I think we'll have a better clarity. I request everyone to close their videos.
I guess now, is it audible, Ravindra?
Yeah, it's audible now.
I think now it will be a little better. I've changed my network. Okay, sure. So please do let me know. I may not be seeing the chat like Ravindra, you did. Any of us, please alert me if
Sure.
the audibility or video is not clear. Okay, so let us. So then we were talking about impact of all of this in valuation of the enterprises. We'll see, and then to some extent we'll see on sectoral analysis also, because that is very vital now, as to in these situations the valuation sector or neutral, that will be very important. And then finally we'll see what caution we take and while issuing the reports by considering all of this what we discussed in 1 to 1. So moving on. So in terms of the background of the entire issue, WHO declared it as pandemic in March 12th. And earlier the expectations were that this is only a crisis of China. It's become a global crisis now. And globally, consumption and production both have impaired, and also definitely services to a large extent it has impaired, but little lesser. But consumption and most economies, though there have been talks that US will start again in some way, and China has already started Singapore tried starting back, and once the lockdowns are out, the number of infections skyrocketed in one day in such a small country. There was when they removed the lockdown. So likewise, most economies paused, but there are some places where it has been seen for revival. Even in India, most of the states are seeing how it can be.
Sorry to disturb you. If you have kept your mobile next to you, I think you should keep that away. Might be that is one of the disturbance.
Okay, now I connected the mobile internet only. Earlier I was working in Wi-Fi. Now I connected my mobile internet. Still is not good, is it?
Yeah, it keeps breaking, but it's fine. You can continue.
Okay, sure.
I think it's not internet issue. Issue is I think the speaker or something is touching the issue.
If you can use a headphone or something, perhaps that would be helpful.
Okay, give me a minute. I will just try that. Am I audible now?
Yes. Yes.
Now it is clear. Now it is clear. You can continue.
Okay. Sorry. Okay, and then boundaries have been redrawn. Now, I mean, there is nothing much I want to discuss on this. There is a lot of geopolitical issues are happening, and we'll see a lot more to come in the near future for sure. And a lot of economic stimulus have been provided, and looking for the recovery. So in all of these, over 1.6 lakhs that's already happened, 23 lakh cases. Yesterday, when my team was preparing the presentation, we had put 70 plus countries, 1,000 plus cases. While I've been speaking now, we had to change this number to 75. That's the one indication which shows the.
Ravi, lot of disturbance, Ravi. Not at all hear the voice.
Okay, now also shows it.
Yeah, there are some issues.
I think why don't we conduct at 12 o'clock, Ravi, by sending a new again?
No. New link. Huh?
I think the problem is the network only at the speaker's end. If speaker is able to do something, because other voices are all clear.
Yeah, like Avinash's voice is pretty clear for me.
Yeah, so if we can have the network check of the speaker, then everything will be cleared. If you have an alternative mobile connection or something, try to go on that. Hotspot of your mobile. If you are using Airtel, you try using Jio or Vodafone.
I will try once. I will try.
Multiple mobiles, no? Just go to the data of any other mobile.
Just try testing your audio.
Chinmay, just do a speed test, no?
Yes, yes.
Speed test and network are two different things. If he is checking his speaker and mic at his own location, network doesn't come into picture.
Is it in any way better?
This is a network issue. my voice is audible to everybody clear and loud?
Yes.
Yes.
Ravindra is same clear and loud. Shilpa Kiran also try to speak for a couple of seconds and see if it is clear and loud.
Yeah. Is my voice clear?
Yeah, pretty clear. It's clear.
No.
Can hear it very well.
So
Not
now
from me.
only the issue is the network available at Chinmaya's end. If he has any other alternative network, please try that.
Sure, sure. Now I just changed again. Is it any better or is it the same?
It's breaking.
It's okay.
It's not
I'll
even
try
comprehensible.
also. Okay, I will try also to move my place to another place.
If you are using on some mobile device, try to keep it near the window or somewhere.
Ravi, my suggestion is one can present it and Chinmay can speak so that there is a split of the network.
Okay, Chinmay, can you share that PPT to me?
Okay, sure. I will do that. Can we just see one last time? I just now sat next to the hotspot.
See, even when nothing is shared, Chinmay's voice is still breaking.
Yeah.
Right now, nothing is shared from his end, not even in video.
Sure, I will. Yeah, I will do one thing. I'll share my presentation with Ravindra and I'll log on through my mobile. Maybe that will be better for the voice.
Definitely, that should help. And you have tied Ravindra to continuous.
What?
Now you are a runner along with the batsman.
Yeah, I'll do that. Anyway, I'll be actively participating.
You can't relax now.
Yeah.
Whatever runs you run, it will go to the batsman only. You can't go for a cup of coffee or anything.
That's fine.
Yeah, but it was on the lighter side only.
That's fine.
मत कर मुझे कुछ भी मत कर अभी तो क्लास चालू है
क्लास के माफिया के
Yeah, now, Chinmay, can you try out? Chinmay, are you there?
आवाज
Am I audible now?
Yeah, clear.
Okay. Hope the voice is clear too.
Oh, yeah, loud and clear. So far, so good.
Good. Okay, great. I think we should be good, and I'll try to be little quick in few slides to make up the 10 minutes loss. Ravindra, you can go to full screen and next slide.
I've gone to the full screen.
Next slide, please.
Yeah. This one?
Ravi, it's not full screen as yet.
Ravi, the bottom this thing next to the slider bar, there is a presentation, single slide.
Yeah, presentation mode. Yeah, you'll have to go to the presentation mode.
Go to the presentation mode on the next left side of the slider.
This one?
Left side of the slider. Yeah, now it's correct.
Okay, great. Sure. So once now okay, anything to be repeated from the previous slides if we have lost, or how do you suggest? Or should I just move from this?
I think you can move ahead. I would say.
Okay, sure, great. Okay, so now because we are there in the crisis situation still, and we are not looking at this as a history, and also because of the fact that this is one of its kind, there are some aspects which we are not clear whether those are facts, they are truth, they are myths, and only the days to come in the future only can say. And those facts are very, very relevant to assess the economic situation, to assess the impact on it in investments and valuations. A few I thought I'll just throw up here, though will not spend much time. Firstly, there were some gossips kind of thing earlier. Now there are clear statements made by some political leaders and some healthcare chiefs of the world as to whether is it a man-made virus or is it really the natural virus is what we are thinking of. This fact could change the diametrics of everything. Second point is connected with this, whether is it a biowar. If it is a man-made virus, definitely it's a biowar. And the next aspect is the death counts. Is it really what we're seeing is the actual scenario, or is it too hyped, too much submissive? Especially for China, I mean, we need to be clear as to whether that is the fact or not, because it is not just from Chinese economy. It is also because China is, everybody in the world are thinking China has already seen this phase and they're back to normalcy, and all other economies can follow what they're doing. When we are thinking like that, we should know whether what has happened in China is true or not. And so because of this reason, not only in China and few other parts are also I mean, there are doubts raised, concerns are raised as to whether they're all the actual numbers or not. And then the next aspect is the stage of vaccination. Again, there are a lot of debates, a lot of talks as to what stage the vaccine is in and all. This is very important because as of now, it doesn't look like there is a cure for this. Even the lockdown situations are there. As I was giving the example of Singapore, I mean, people, we're just thinking that as long as lockdowns are there, we are in little control, and once the lockdown is open, it may just come back like how it was originally. I mean, before the lockdown, or lockdown was never there kind of situation. So vaccination is the only thing we can hope for, at least on a long term solution. Even say after 1 year, 2 years also, if solution has to be there for this, maybe vaccination is something which is very important. And people are talking about the second wave, which is once the colder season starts, especially towards the September. I mean, nowadays people are saying it's almost for sure that second wave will be there, and we need to see whether that is true or not. Again, vaccination is an repetitive, I think. Medicine, so again, there is no cure as of now. So whether some cure would be found, then that will again would completely change the direction of what we think about its impact. And finally, is it a Cold War or a World War? Anyway, once all the above questions are answered, I think this will also will be very clear. So I'll just move to the next slide. Ravindra, can you just move to the next slide? Ravindra, can we go to the next slide?
I have gone to the next slide. It is not showing you?
No, still the previous only is coming.
4 of 25 only is visible to us.
Now it's visible.
Yeah. Okay. So now coming to little more specific facts of some statements by global bodies.
Still not in presentation mode here. The bottom four, yeah, that one. That click that icon, yeah.
If I click on that, when I try to move to the next page, it's not happening.
So then you move to the next slide by the arrow keys.
Arrow key only, it didn't work for me.
Even I had the problem when I took some other session, no, same. If I go for slideshow, no, I can't see anyone else.
No, it's okay.
Okay, let us continue this way, maybe.
On the top, you will see speaker view and some other viewpoints on the top right corner. Then when you press that, you will see 5 persons on the left hand side in your slide as well.
Okay.
Shilpa.
It's 12 o'clock.
Shilpa.
Yeah, tell me, I didn't hear.
Yeah. When you are going for the slideshow and when you share your screen, so it will be showing on the top, speaker view on the right corner, and then there will be one star there. So then you will see 5 different people.
Okay, fine.
And then if you hide that, there is a slider to make it nil also. Then only this thing will come in one corner, larger area of your end. You just experiment a bit when you, because this is a future which will be coming.
Yeah, fine.
Okay, sure. So in this slide, in summary, what we need to know is definitely there is almost a clear indication that there will be a shrinkage of the world economy by around 3%, and most countries would growth would be negative, especially advanced countries, and very few countries may marginally grow. But what is very important to note in this is the first positive statement in the last half an hour is the numbers of 2021. So definitely some spillovers of what did not happen in 2020 will go to 2021, and there would be much more increase in the world output and the growth economies and everything in 2021 compared to even what was projected for 21 before this COVID situation. So it is not that everything is lost, whatever happens to next 1 year and drop in growth and everything is not complete loss. Definitely it will be recouped to some extent in the coming years. So that is one thing we should not forget when we approach not only on the economics, but even in coming to the specific companies cases also. Definitely what is lost completely would not be lost permanently. There would be some regain of it in the years to come. The next slide, Ravindra.
This one?
Next slide.
We are saying 5 of 25 only presently.
No? I'm seeing the differential.
Yeah. Now it changed. So actually you can, this is global index. Maybe Ravindra, you can move to the next one. So here what we are seeing, the drop, similar drop is there in India also. Let us see more. Yeah, let us see this from India perspective. The graphs are not too different, but one is it is very surprising for me that the impact is not as much as in India, in US. And also some other economies also, it is not as much as in India, and certainly in China there is no graph like this at all. It's a completely different graph. That is another very important thing which worries me also. I mean, which leads to the indication that it is all controlled and made by Chinese. While in this graph, one thing we need to see, already a lot of recovery has happened. If you see from 23rd March, already a lot of recovery has happened. So this is something which is a little confusing also, the way the markets are moving. Because in any other situations earlier, there is no such, even this kind of small half U-turn also was not there. V-turn was not there in the earlier crisis situations. This will be very evident in the next slide. Ravindra, next slide.
Can you see it?
Yeah. So this is the Nifty PE movement. PE movement is a clear indicator between the periods, because when you compare, say, Nifty or Sensex or S&P, then absolute numbers, if you compare, comparison would be a little different because the values would have changed and markets would have grown between the periods. So now here I'm trying to see Nifty PE from 2008 crisis period to now. So if you see, the peak was around 27 or 28 in, if you see November 7 to Jan 8, in between that the peak was around 27 FTPE. From where, because of the financial crisis, if you see November 2008, it dropped to around 17 point, dropped to in fact 12.72. If you see Jan 09, it has dropped to 12.72. And in fact, it had even touched 10.4 in between. This is a monthly average, so the below minimum is shown as 12.72, but it actually touched 10.5 also, Nifty PE. And then between to November 2008 to November 2010, for around 2 years, it grew again back to 24, Nifty PE 24. So it took around 2.5 years, and the fall is from 24 to 10. So now let us see what the graph shows for this year. Ravindra, next slide. This crisis, COVID crisis. So here, if you see, there is no such deep fall at all. 27.95 was in Jan 20. So which has dropped to 19, which is maybe as on today or few days, and it had when it had the deepest fall, it touched I think 17, not below 17. So we have not seen Nifty PE touching anywhere close to 10, 12 or the numbers which saw in financial crisis 2018, 2008. On the contrary, this crisis is seemed to be much larger and much deeper than 2008 crisis, but I'm not very sure why the markets have not as much badly reacted as in the past. So these all are the few points which adds to a lot more opaqueness of the issue, whether is it been too much hyped or is it been too much neglected. So we are not at all getting any clarity on this aspect. This is just one indicator. Likewise, there are many other analyses which we made and many people have done in this area, but each one leads us to different conclusions, and we are not very clear as to at this stage really where is it going. Do we know completely the impact of it, or we don't know? We just don't know as of now. So understanding this as to the lack of clarity and everything what is there as on today in the global markets and also the general economies, let us move a little bit towards VCPE space. Ravindra, next slide, please. So
have we gone? All right.
No. Yeah, so nowadays most VCPE deals will be influenced by one investor, which is SoftBank. So let us just see a little bit about SoftBank, which largely should translate to the entire space, because in this time we can't quickly get the valuations and the space and as such entirely. So I've tried to just see the SoftBank movement. So March 20, 2nd March 2020, it was valued at 5,000 in the Tokyo Stock Exchange when the impact of crisis started, and 19th March it touched the lowest of 2,600, and again it has recovered to 4,700 by 17th of April. So this also again we are seeing the same V-shaped recovery as similar to the other markets. And this is another fact which again says that if you see similar crashes in 2008 and 1999, 2001 types, so there the fall was retained for a much longer time and the recovery started much later. So similar to the markets what we saw in the previous slide, even if VC space also seems to be seeing the same thing. And apart from this, okay, this is just as one indicator of SoftBank. Now, while I talk to any of the Indian VCs, Indian focused VCs, most people are just there on track of their normal routine. However, they are little cautious on making, on two counts, transactions are not much happening now. One is because of the very lockdown and other scenarios. And secondly, because the economic impact will be there for a few more months or possibly a year or so, people are trying to save cash in order to invest in the existing portfolio companies. Say if the existing portfolio companies have say 6 to 9 months runway still, they are little cautious because if after 6 to 9 months, if they are not able to progress to the next levels or not able to attract the new investments, so these guys wants to do double dip, and that's why they are saving little cash. But apart from this slightly conservatism, definitely none of the VCs and Ps are looking at this situation as something very bad, negative. Their lives are as usual except for the lockdown situations. So
Chinmay,
this is,
if I may interrupt, I have a small question here.
sure.
What is the message that you're trying to give by showing the SoftBank stock price here? Because SoftBank, even prior to COVID, was having its unique set of issues, particularly post the WeWork fiasco, and in India, the increasing competition for Paytm and Oyo. It was more its own investment companies specific issue there. So I'm not sure that what is the message they're trying to give by showing the SoftBank share price here.
Yeah, sure. So firstly, as I told, SoftBank is one indicator where the movement of its and increase in valuations or everything will will determine the paths for few other investments also, because SoftBank seems to be like an IPO situation. Once all the investments others have done, SoftBank's buy side, or many people even targeting to sell out to SoftBanks in some point of time rather than do an IPO. So as a space, as I said earlier, it's a very short span of time and to analyze the entire VC space. So I'm just taking one stock bank, which is largest fund and more impactful fund in this stage. So that is the reason I'm taking this. And to answer your other questions, it had issues, but even if you see the graph itself, that was not showing that was not showing in the market. The impact was not showing in the market. If you see around November or somewhere, the graph has started here. There is an uptick only and there is no downward movement. Though a lot of issues are there with some of its portfolios, still there are, I mean, it's a large portfolio. WeWork is very big impact, and even Paytm, Oyo also could be very big impact, but it's a much larger portfolio. So I don't think 2-3 cases will lead to such a big problem. We can still see them as some benchmark to assess the sentiments of the market, at least. We're not trying to measure whether they are successful or not, but at least just trying to understand the sentiments of the market.
Actually, my question was more that are you by this graph showing that this is one additional factor that will impact valuations, or are you showing
I'm trying to say that the stock market, firstly, in my previous slides, as I said, stock markets are not showing as bad impact as we think in the think, or maybe we evidentially see the deaths and everything. Stock markets are not showing it as bad as that. And even apart from stock market, even VC and PE investment space also is not reacting for the situation is as maybe as bad as
Yeah,
what we are thinking.
that is what I was trying to
Yeah,
get.
yeah.
What is the message? Thanks. Thank
Sure, sure. Yeah, and apart from this SoftBank, as I was saying, when I speak to all the VCs we work also, I don't see too much negative sentiment similar to the graphs of what we are seeing. So there are not too much negative sentiments except for the temporary phase of correction. So I'm trying to highlight the difference between first few slides where everything seemed to be very negative, very dreadful and very fearful situations, but actually that much is not transpired in the stock markets. So we need to be very careful about this. Maybe something we are totally missing, something we are totally missing means the entire media and everybody, but the capitalistic pockets have not thought, maybe they have a better information, or that is the only possibility. I don't want to assume that they are lacking rationality. Definitely they would have some better visibility or wisdom in this area, and that's why the markets and the investment scenarios are not taking too big at all. So yeah, moving on to the next slide. Maybe next slide is just a breakup of the thing. Maybe we will just skip that and just move to next slide, Ravindra. Okay, so here if you see again, there have been these are the list of investments which has happened in India in this month or slightly earlier this month, but definitely completely in the corona virus situation. Big Basket has received funds, Fasus, Navi Technology. So there is a list of these are the list of a few lists which is I mean there has come on the papers and which is a talked about deals. Apart from this, there are a lot of other investments also which is happening, and in my experience the transactions for which we are doing the valuations in around 15 to 18 valuations which was happening in the last 2 months, only in one instance I've seen the deal being stopped, and one or two instances have seen it is getting dragged to next few months or so. So if we see this also, there is not that indication of any very big deep impact kind of a thing where transactions are stopping, not taking place, and all kind of like say world. If we had to compare this with a World War II situation, I don't think we are seeing such a situation here in the investment scenario. And all of these listed transactions, what is there in the screen, none of them have taken a hit on valuation. The investments have happened in wherever there are follow-on investments with agreed investments have happened at the similar prices. Though I may not see too huge uptick in the valuation, but definitely there is no fall in the valuation. So that is what in this slide. So again, this reaffirms that I don't know whether we should just be carried away with whatever we see and hear about the economies, because the investments are not happening that way, and they are a little more optimistic or on a positive side. Next slide, please. So now here on, I'm trying to move slightly towards as to whenever we are trying to value what, now that we are understanding the two sides of the issue, let us try see what we should adopt to in our valuations. So the above tagline, as I was saying, it was the best of the times and it was the worst of the times. Nobody knows what it will be finally. So let us split the companies into, especially when we are working on the startups valuation or even the matured companies also, more so for the startups. I've tried to split this into two things. One set in the left side, which has a cash runway and which has a sustainable model and profitability. And the right side, which is having a lot of cash burn, it has to still scale up to become successful, and a lot of growth pushes there. The left side companies would be easier and good to, and the right side companies would be difficult to think and analyze at this stage. And even in the investments cycles also, there have been clear shift in these parameters. There was also in the last 2-3 years also there have been a shift in this direction, but now definitely it will be a lot more in the days to come. So if we are valuing any company which is which we will need to have a lot of cash burn, and scalability will take a lot of time, and they are just eyeing towards growth and not profitability, definitely there is a high risk in such companies, much higher risk than what we would have perceived earlier. So this is one specific thing we would need to consider from all of this. Whether we are there in the first 6 slides kind of a scenario or the later 3-4 slides kind of a scenario, but still this is for true, which is happening. We don't know whether we are in deep trouble or we are in just temporary bad phase, but in whichever case this is true, which is happening now. A lot more companies are not seeing too long a scalability and cash burn situations. They want quick returns now, which has already happened. So specifically in the in relation to, let us split it between the different stages of the company. In the seed stage investments expected to pick up very quickly, with definitely there will be some changes in the parameters, especially in for the seeds kind of a startups. Some of us used to value them even based on the entire company, entire sector valuations. For example, if you are in the seed stage, I will value it at say $1 million without even going to your DCF, without even going to. So that is a method which is accepted also. So, and definitely which we used to do it as a sanity check. So that we need to revisit now. Can we definitely there would be a downtick in this in the seed stage valuations. Earlier, if companies used to invest for say 1 to 2 million valuations on the seed stage, definitely that will come down a little. And Series A and follow-on investments, now there'll be a lot of filtering happening now. The investors are trying to pick and choose who can live and who can die. And so Series A stages also, we would see that there'll be a lot of issue in raising Series A funds, because investors would be much more choosy. And this is like a litmus test now. When this kind of a scenario which has happened, there are companies can survive or not, it is very little more easier to make out. Having said this, definitely fear of missing out would be there for the investors, no doubt about it. And also, apart from fear of investments, fear of missing out the investments, there are not too many alternatives also available for the funds who have already raised the funds. So any of the VCs or PEs who have already raised the funds with India focus, there is no other alternatives also. Definitely there is no places where they can invest the money and still match, or even slightly lesser than matching the returns which they have assured to their LPs. So in that way also, definitely the money has to be invested in India itself. But maybe, as I said in the first 2 points, it may be at least slightly better valuations and maybe at a slightly more positive and companies who can survive all these situations. Next slide, Ravindra. So we need to, whenever we in these situations, when we are seeing the valuations, we need to break it into 3 periods as to when we are doing the valuations. If we are doing the valuation pre-impact period, before all these virus issues and its impact everything is started, and during the impact period, which is now, and also maybe possibly for a few more months, and in the recovery period. So once all these things happen, once at least the clinically virus we have come out, economic situations may continue, but at least clinically and in terms of the infections and all is not there. So at that time, if we are valuing, so these are the 3 time periods. We need to look at it separately when we talk about impact on valuations because of this issue. Next slide, Ravindra.
This pre-impact period means the period you're talking before 12th of March 2020.
Mostly before the 12th of March. So in case, even though we are doing valuation now, for many reasons, we may need to, valuation date can be earlier date. If the transactions happened in the past, or for whatever reason, the date can be earlier date. Though valuation report date is today, valuation date could be earlier date. In those situations, I'm talking about it. Okay, so these are in the earlier slide, those were the 3 time periods we need to be careful. So if we are there in the earlier valuation dates, then the valuation, even though everything has changed today, the valuation should be done as per the date on which the valuation, as date on which the valuation has been done, though the report date is today. So our valuation should not impact if we are doing the older dated thing, but maybe a disclosure in the report may be required that though valuation as on that date was so and so, without considering all the changes which has happened. But while we are signing the report, it has already happened. We need to make the disclosure that these things have been happened between the valuation day and the report date. So the reader should take the cognizance of that. And then in this slide, it is just a prediction as to whether will be very favorable situations are there, that is quick retraction, very quickly will come out of this, or a slightly slow retraction, or a retraction is unpredictable. These are the three possible scenarios of the future can happen. So when we do the valuation as on day with the current dated valuation, these three splitting up into these three scenarios as to how do we see future is very important. Of course, as we saw in the initial slides, we would not be able to judge and conclude which three situations are possible. But however, maybe possibly in 1 or 2 months or so, and especially in the previous slides, third scenario, if we are doing the valuation during the recovery phase, definitely out of these three scenarios, one would be most obvious at that stage. And even now, let us see as to how these three possible future scenarios can work out and what we should do at that time. Firstly, quick retraction. If this is what is a scenario we look at, that means the impact would be there for a few months, maybe March, April, and say May and June maximum. This impact would be there, and after that, complete lockdown and all will not be there anywhere, and every industry will start functioning in a phased manner. If that is what is the quick retraction scenario, and economic recovery also would happen in say a couple of years from now. And market trends reasonably predictable. So if this happens in this quick retraction situation, market trends will be reasonably predictable in our, say, the projections what is been provided by the clients, at least the trends we can see. Because if we know that it's a quick retraction, we know that the maximum impact is say 1 to 2 years, and after that it will be back to normalcy. And in such situations, what all we need to take care in the valuations. One is cash flows. We need to see that if it's a quick retraction situation, the cash flows and the projections have been appropriately adjusted for that. Discount rates, I don't think any adjustments should be required for the discount rates in this situation. I'll come to discount rates in a little later, but in this situation, definitely no discount rate adjustments would be required. Valuation multiples, we need to be careful in taking out the comparative numbers. Say, for example, if I'm taking in the market approach, if I'm taking the valuation multiples, say if it is based on turnover, and if I take the turnover of say FY20, which includes March month, there will be a big impact in the March month. So those things we need to take. An earlier transaction, say in August, one transaction has happened, and I take that multiple, say August 2019, if a transaction has happened, and if I take that multiple and I try to apply for my company which I'm valuing based on March 20 numbers, then I need to be very careful, because there would definitely be an impact of this. So those adjustments we need to take when we take valuation multiples. And there are other valuation assumptions also we need to retest, but may not be too much adjustment would be required in quick retraction situation, but we need to retest. And definitely disclosures in the reports is required. We'll come to what kind of disclosures maybe a little later. Then in the second possible scenario, which is slow retraction, if it seems like up to 1 year period, it will still be there, a lot of restrictions on economic activities also will be there, then recovery period could be definitely beyond 3 years. If 1 year is halted, definitely complete recovery would take beyond 3 years, or maybe it could be unpredictable also. It depends upon for how long the impact period would be there. And market trends could be even predictable, because what happens is what is the difference between market trends predictable and not predictable is if the impact period is such large, even the basic behavior of the consumer changes. then market trends cannot be predicted. With how much ever research and how much ever deep analysis, market trends cannot be predicted. If this impacts the basic behavior of the consumer, basic preferences and basic necessities also, if it changes, and also the various geopolitical and other things change, then market trends would not be predictable. But I don't think if the impact, even if it lasts for next 1 year, still market trends or the generic behavior of the consumers and all may not change, except for, say, for example, in tourism, definitely there would be little more unpredictability. And say restaurants and such kind of dining related companies, there could be slightly unpredictable. If it goes for 1 year, maybe many benefits, many habits of people may also change, so that those spaces may have little unpredictability even in slow retraction, but largely trends could be predicted. So in this situation, what is to be done? Certainly cash flows to be seen, and discount rate, I think even in this situation there is no need to change the discount rates. Anyway, we'll come to discount rates separately. And sensitivity analytics would be very useful if we can make two three different possibilities and do the sensitivity analytics. Would be useful, and report disclosures is required. And next, coming to the third situation where retraction is unpredictable, that means impact period, definitely it is more than 1 year and we do not even know how it is. For example, as we saw, if this has a second wave of infections, and if there is no vaccine and there is no medicine cure available for the next 2 years, then we would not even know how deep it will going to be and how far it will going to be. And definitely everybody, all the countries would try to want to come back to economic activities, even though they have no control on the infections, because that is the only way left. Instead of everybody dying with infections, it is might as well better to run some economic activities. Maybe that could be the way in which it will be seen, if we are seeing the situation in such a bad shape. So in that situation, impact period is not predictable and recovery period also is not predictable, and definitely market trends are not predictable. Once everything is cured, say after 4 or 5 years, we don't even know how the world reacts and how our lifestyles will be. So this will have a lot of ambiguities, and a lot of disclosures or disclaimers would be required in our valuation report. But I don't see we need to spend too much time on this last scenario, because I'm not sure. I don't think this would be a reality, but definitely a possibility. So when we are depending upon which period we are valuing, as we discussed in the last slide, we need to see and choose what is our outlook to the economy and the projections of the company concerned which we are valuing, and accordingly try apply these parameters. Next slide, Ravindra. Okay, so now in this again. Okay, anybody had any question? I saw
Chinmay, actually what I wanted to ask you, this scenario analysis, okay, yeah. Suppose we make scenario analysis, we give weightage to the slow retraction, quick retraction like that, or one particular approach we go ahead according to the industry and one approach is...
Yeah, as of now, if we need to speak, see, giving a weightage will lead to a lot of ambiguity. Initially, we may think 3 scenarios. Okay, anyway, we are giving weightage. Maybe some 10 scenarios will come up, and everything we should give weightage. So we will try at least as much certainty as possible. I think, given, say, if we are valuing today, definitely, I think we can go by quick retraction kind of a situation, because I don't see too much. Definitely, especially from the last 4 or 5 slides, what I saw, the markets have not shown too much impact, though other things are very dire. So maybe we should choose, in my opinion, quick retraction kind of a situation. But
no,
if we
again,
are
it
doing
depends on the sectors, right? See, something
sectors,
like
definitely.
Yeah,
sectors I'm coming in the next slide, the slide which you're seeing now. But this till now it is generally I'm speaking. Definitely, depending upon sectors, it would change a little. Okay, so coming to this slide, so there are 3 buckets in which we can bifurcate the industries now, sectors now. One is whatever industries which is having an upside, and neutral or partially downside is the second one, and third one completely downside. Upside would be the industries, could be pharma, research and medtech, agriculture and processing. Definitely there is a lot of uptick. Food and drug retail, telecom, telecom and edtech and media content is mostly because of the lockdown situations. It may not be too permanent, but definitely this is already changing behaviors. Many people are considering almost every software ITES company in India are considering to do more and much more work from home than they used to do earlier. And this is very apparent. Even I am considering for my work, definitely in my office, definitely we can do a lot more work from home than what we used to do earlier. So likewise, even though it's a temporary, telecom, edtech, and media is slightly temporary, but I think there will be a little more little more impact than just a temporary. So there will be definitely an upside, more upside than what we used to see earlier. And e-commerce definitely, because now everybody wants to a little distance and little automatize definitely. And consumer technology is another thing which would see an uptick. And almost neutral or partially downside, hospitals would be almost neutral and partially downside, because there has been, unfortunately, there has been a lot of, especially when we talk about SME space, there have been a lot of hospitals which are in trouble because there is almost zero revenue kind of situation. And all the other costs are fixed costs and everything. Likewise to other sectors, even they are also badly impacted. And another very important thing why it is partially downside is there may be a possibility that going forward people will be a lot more health conscious and a lot more, even though earlier they were health conscious on paper, now maybe in practice people will be there. And also we have already seen in the last 2-3 months a lot of our clients when I was speaking to, and also some of the well-known doctors have been spoken this in the last 1 month in Bangalore, as to even the heart surgeries have come down to 20-30% of levels of the normalcy. One reason is because there are not much activities, so people are not getting excited, anxious, or anything which is leading to this. So even other treatments and everything has come down drastically, apart from lockdown, because a heart surgery cannot wait for a lockdown. When something has happened, definitely they'll go to the hospital. When that can see such a big dip, cut, definitely all other cases. So it is not very clear as of now as to whether what will happen in the healthcare industry. Definitely some impact or some change could happen, but it is not very clear. That's why we're not saying it is downside, but definitely some partial downside, immediate downside could be there. And it's a very complex market. Healthcare is not as simple as such. It is a lot more to do with psychology. It is a lot more also on the other end to do with your all insurance and a lot of big guys, how they are influencing the political leadership and economic leadership and capital investments. So it's a very complex, but that's why possibly as partial slowdown or downside could be there in the hospital. Building and construction, already it was, they were in trouble. Now that will be a lot more increased for sure, because of generic reasons, and also because of a hit in tourism and hospitality as such. Then financial services also should be uninfluenced or maybe slightly influenced by these things. Metal and mining, pure play technology, power, they are all the basic necessities. So we don't need to see that as a downside for them for sure when we are valuing. Then what are the sectors which may have clear downside? Travel and tourism, aviation, for sure. Automobile and components, not as much as travel and aviation, but slightly, definitely a slight downside. And to some extent, even work from home and the revised lifestyle conditions and working condition could also have an impact on auto. And apparel and textile, beauty and luxury, because these are all slightly on the luxury side, and also to the revised conditions of working and everything, this could have some downside. And also when people are not having money for the basic necessities, definitely these would take the next preference. So depending upon each of the three, yeah.
Chinmay, this IT and real estate has not been mentioned in this analysis.
Real estate, when we say building and construction, somewhat real estate is similar to that. So it is there in the partially downside, building and construction. Real estate also would follow same. So IT has been split into two things. One is consumer technology, if it is lot more towards the end consumer kind of driven. For example, what is adding to our comfort and other things, it may be little difficult going forward. But basic technologies, base technologies, which is say ITES support and those things, there should not be any issues with that basic technology kind of thing.
Okay.
So yeah, so depending upon these three these three buckets, we should see the consumer sentiments and the demand and everything, and accordingly it is clear which approach we should take, and accordingly the valuation inputs and also the projections, we should ensure that they are in line with our analysis. Next slide, Ravindra. So maybe I want to take should I take a slight pause now, and because going forward is a small portion is left where we see as to understanding all these things. Now how do we implement this in say income approach and market approach? So should we take a 5-10 minutes break of understanding if there are any questions, anything to be revisited, or we should complete it fully and then take questions? Either way is okay.
Yeah,
Let's
I
complete
have one second. I have just one small review.
Sure.
See, you said that there has to be a pre-COVID period bifurcation. So if the valuation date will be the current date going forward, then in that case, the company's revenues will be bifurcated into pre-COVID period and post-COVID period.
No. If the valuation date is pre-COVID period, then nothing will change in our valuation reports, valuation inputs and arrived value, but only disclosure, we need to disclose that though valuation date is old, that's why no impact has been done for the valuation, but we are giving the report today, so we need to disclose to the reader that these all things have happened post the valuation.
Valuation date is itself the current date, that will be the future date. Post-COVID date is the valuation date. So in that case, the revenues will be bifurcated into pre-revenue and pre-COVID and post-COVID period.
Yeah.
It depends when you want to see. It depends when you want to give the valuation, because the date of valuation, if it is already passed, let me say in March or something, there is no data to receive for going forward till next 3 months.
No, I'm saying the valuation date, the date of valuation is post-COVID.
Say we are doing valuation as of 30th of April.
Yeah, so in that case, the revenues will be bifurcated into pre-COVID period and post-COVID period, plus the sector will be also bifurcated. The sector in which that company falls.
Post-COVID period means you are talking about 1 month of April.
Yes.
There will be hardly any data to suddenly dip it down to zero, because you know the graph, like we had seen the earlier sheets, during this period the business has become very, very low. That doesn't mean that the valuation will be down to dirt. We will have to make some assumptions on the recovery part. During my valuation examination, I had a case study which was related to Afghanistan type of war situation. What was the condition of the economy before a war had started, and then that country faced a 4-year war period. They had given certain numbers. The country was in the growth phase at this particular rate, and then suddenly the country has began dipping, and now the economists are feeling that the company is on the path to recovery, and then they had again given some numbers. So right now, looking at that, we will have to again look back such similar examples. We will have to pick up what happened in 1971 war with like this is a war-like situation. So a lot of things are subjective, which we will have to take on the account whether we have reached the trough or we are still away from the trough going towards the trough. I hope I am able to explain what I want to say. So we are approaching a trough phase.
Yeah. So maybe, madam, with an example, if we need to say, for example, if we are valuing a restaurant chain, so if they have drawn a projection, definitely the projection should not have anything, say up to May also should have very minimal numbers, and up to say end of this year, they should have maybe 30-40% or 50% kind of the numbers what they would have seen earlier, because definitely a lot of eating habits would take it all for sure. And then after that, there should be some growth, and maybe possibly 3-4 years later, if they say year 4 and year 5 projections, if they have not changed because of COVID, that should be okay. Maybe in that way we should analyze.
Exactly. In my case study also, there was something like a similar example.
Agree, sir. Agree.
The economy when the war started, and then that 4 years is the war period when economy has told everything negative. And then they say that now the war is over and it is trying to limp back to the regular this thing. Now, as we know, it is very, very difficult to predict, but keeping all these parameters in mind, we will have to give the valuation and a footnote that this valuation is a chance of going not true. Again, we will have to review instead of a normal cycle of 2 years, maybe after 6 months or maybe after 1 year when more data comes in.
Sure, sir. Any other questions?
This is my point, because I had a similar example in my valuation exam itself.
Yes, sir. Agreed, sir. I mean, even I'm in line with what you're saying.
Chinmay, I had one question. Now, I feel building and construction, as in if you look at it as a whole in terms of real estate, that might have a huge downside, because until now, commercial real estate was a major hit for all the builders. They have a lot of unsold inventory in residential, but commercial was raking a lot of money for them. Now, considering this COVID scenario where there'll be a lot of work from home, don't you think the demand for office space is going to come down, and then?
See, real estate has three kinds of challenges possibly. One is the companies which are already into real estate, especially commercial. 99% of the clients will not pay, tenants will not pay for this period of lockdown, while their interest and other costs will remain. But this lockdown revenue, everybody are invoking force majeure clause and they're not paying. And then already post-COVID, post-lockdown also, already negotiations have started where most people are asking for at least 20-25% of reduction in rent. So this is one major hit to real estate, especially in the commercial space, if they are, which will be there. And then second point is what you said, work from home. Definitely that is an indicator, and there is a feeling that it may happen, but I'm very doubtful if the impact would happen more than 10%, because even though say for example, say 30% of the staff is work from home at any given point of time, it is not that complete 30% can be contracted, and say if they are operating in 1,000 square feet, they will operate by 700 square feet. I don't think that quickly adjustments will happen, and also other growth will be there. And so see, generally, so that way I don't think just because of work from home too much impact will be there, but could be some marginal impact would be there. And other aspect is in real estate, see, it's a physical space, right? So whether they're staying in office or staying at home, for example, if people are used to stay at home and work from home, do they need to have a office at home itself? I mean, all this while they would not have bothered about having a secluded place which is enabling for the Zoom call or enabling to facilitate work. Now going forward, they may need to look at it. That means some activity in real estate. So I don't think there will be too much impact will be there because of this, but definitely it is little dicey now, and we may need to just wait and watch.
So do we take a pessimistic view or optimistic view for real estate?
See, for real estate, if we are valuing today, anyway, they were in lot stressed, depending upon what nature of real estate they are. If they're in the commercial space, definitely a lot more changes should happen in the projections after post-COVID.
Let me just chip in. Sorry to disturb you. I'm also a valuer for land and building.
Sure.
So when we look at real estate in the current scenario, when we do the valuation, most of the time valuation is done because it is being given as a surety for somebody.
Yep.
And if our valuation goes drastically wrong, then valuers are getting challenged that why you did the valuation ignoring the current feasible scenario of the COVID. Being optimistic will be very, very challenging for a valuer per se. So more knowledge is required. And then I will say that don't try to go on the optimism side that everything will improve for real estate, for businesses and everywhere. More and more businesses are likely to be going into stress more and more inventory of the existing sold inventory is going to come back to the market. So when we are looking the valuations in the real estate industry, normally we feel we are talking about the new construction, new opening up of the construction, new offices coming into the place. In old city areas where the office was too expensive, not available for even rent in affordable times, in coming time that will become affordable. This is my just viewpoint as far as real estate is concerned. Being optimistic, maybe saying that all our valuations may be going haywirely wrong.
No, so by real estate, what I meant is like something like WeWork, which is in the real. You could WeWork, we could say it's like a real estate business only, though they are not purely. It's a rented thing. But what do you think will be the impact on WeWork or maybe Innovate or those sort of businesses?
See, assessing WeWork specifically, I don't want to comment at all because it is not clear at all their revenue models, the kind of valuation they looked at all. There is no parity with that, and possibly we may not be valuing any similar to WeWork companies also of that size and scale. So the second part of the question, like similar spaces you were saying, Innovate and IndiCube and all of this.
Yeah.
So in that also, I don't think say after 1 or 2 years there will be too much change in the way how they were operating today to after 1 or 2 years, because the new offices spaces and new companies starting and everything should happen for sure, unless we are seeing the third category of the situation what I was showing in my earlier slide, like unpredictable retraction. We don't even know what will happen. Lockdowns and all will be there for a lot of period, and habits have changed. At that situation, not only real estate, no other sector we can predict. But as long as we will be there in quick retraction or slow retraction phase, where definitely it will come back. So it will come back, and real estate is something which is hardcore requirement. But what is very important is how much it is already overvalued and compared to the necessity real estate requirement. If there is already a bubble in the real estate space, definitely that will quickly burst and we'll see a doom state in real estate. And so since already a lot of corrections have happened, so in the future, see, from two perspectives. One is projection perspective, another one is ultimate value perspective. Projection perspective, as I told, we need to take a call based on each sector. Like if we are valuing a commercial establishment, then we should see that the projections are factored with this current stoppage of rents and also adjustments of rents which is expected in the near future, or as expected currently which is being negotiated. So our projections should definitely take care of these change in revenue. And in our valuation, other parameters, for example, discount rate, should we change discount rate? I don't think it is required. As long as we are in line with the market rates, that should be okay. There is no need to add, say, additional risk premium because of the real estate space and all. So I think as long as we have cautiously seen the projections, I don't think only because it is real estate need to be done too much changes.
While we do not have to change anything in the discount rates, I think in the short-term scenario, what we need to consider is the increase in the discount for lack of marketability. This would be something which would be applicable for the next few months or years at least, because people would have lesser appetite towards illiquid assets, is what I feel. So discount for lack of market DLOM is something which we have to revisit, is what I feel.
Uttam, I have a slightly different view on that, because DLOM, instrument marketability, see, at any situation it will be there. For example, even now, if the valuation assets are available for slightly lower price than pre-COVID, definitely there'll be 100 buyers for that. And as I was saying already, for example, consider a VC who has already raised the money, and time is very important, because based on time, if there is a delay, their returns percentage of IRR will reduce. That's why they'll be very keen to deploy and do transactions. I don't think marketability will be a concern. And all of these maybe discussions are in quick and slow retraction phase. Definitely, if it is a third phase where nothing is predictable, that's a completely different discussion. As long as we are in predictable scenarios in first and second category what I mentioned, I don't think there should be too much concern for marketability, because as I showed in my previous slides also, there have been investments, there have been fundings which are happening. Okay, so maybe let us quickly move to each of the approaches and see few of the important points what we need to specifically take care. So as in the slide, in the income approach, we discussed projected cash flows, very, very important it is. So we need to very cautiously see whether whatever we feel is the outcome, the projections are in such way. For example, if we feel that lockdown is there now, another 1-2 months, it will have too much of impact on economic activities, and the sector which we are talking will see a bad phase for the next 2 years, and then maybe after 4th and 5th year only, maybe it's the same as pre-COVID period. If we analyze this way, then we should ensure that the management has given the projections in similar way, or if they have a completely different story, we need to see if that merits. Otherwise, we need to push them to factor COVID situation in the way we feel the outlook should be as per analysis what we did now. And the second one is report disclosures. So I think not too much. Just a second. Okay, there is some mix-up in my slides, but that's okay. When we go to the next slide, if there is a repetition, I'll just skip. So report disclosures, as I told, definitely disclosure for this COVID situation is required, because even though the projections are adjusted, still we are not sure as to whether we are there in the third phase or that phase will come, will not come. And it is all our not even estimates, it's just a guesstimate as to what can happen. So definitely the change in, disclosure in report is required about a section separately for these COVID situations, and saying that these all things have happened, and sector wise, this falls into so-and-so sector, and this sector, what is our outlook on that sector, we need to write. And then finally say, because of these things, so-and-so adjustments have been made in the projections and other things specifically because of this COVID crisis. And third point is on probabilities. As I was saying, touching upon earlier also, we should try avoiding probabilities, because as I told, how much ever probability, this is 3 scenarios I just discussed, but there could be 10 scenarios like this we can draw. And when we talk about probability in many things, we can, once we come to 3, there will be 5, there will be 10, anything can be possible. So I try to avoid going towards the probability, because anyway, because there is a probable number of events, that is why there is a high discount. If there was no probable number of events, then we are talking about a risk-free cash flows. So anyway, that has been factored, and I don't think anyone should resort to probabilities. But if there is any specific cases where some cases are there where definitely a pivot point is there, after which it can be, say, this scenario or that scenario. For example, we were working with one last mile connectivity company where they provide transport between the metro station to their house. So there we really stuck between, 3 scenarios where, and one scenario, this model itself will not work, because most of it was co-sharing also, and not an individual cabs, co-sharing cabs. This model itself will not work, and we need to close. And second scenario was it will work as usual. And third scenario was definitely there'll be so many people who take out of it, and many people will start working from home, so it may be difficult. So likewise, if there is any specific differentiators are there, then we may have more than one probabilistic events. But otherwise, generic probability saying economy is good, so and so projection, economy will recover badly, so and so projections. Likewise, generic probabilistic projections, I think we should try differentiate, just to ensure that we will not be in trouble explaining the differentiation later. And then discount. Yeah.
Can I just interrupt you a bit?
Sure.
In Zoom meeting, on top, you are seeing one green bar. You are viewing Ravindra Nath NC screen, right?
Okay.
And on the right hand side, there is a view options.
Yeah, actually screen, I'm not sharing. Ravindra is sharing the screen.
In that view options, there is some fit the window 50%, 100%, and there is a request remote control. can you experiment this request remote control, and then whether are you able to change the slides at your end of the screen? If it is possible, it's a experiment that we are doing on Zoom.
I'm now logged into
So
mobile.
then if you
I'm
are
just
able to change the screen, then it is possible for you to take control of your presentation on somebody else's screen. Otherwise, there is nothing.
understood. I have been doing from my mobile.
I have shared with you that remote control. Just accept it. See if it is possible.
Okay, just 1 second. Okay, I think I've got it now.
Yeah.
Since I'm handling in my mobile, I'm not sure if I'm doing the right thing. Since there was an issue with the laptop, I am handling in the mobile.
Doesn't matter, leave it, leave it. It was just for me to experiment, you know, while we are doing the presentation.
Yeah. The slides, I'm not able to go back. I can do the next slide, but I'm not able to go back.
Okay.
Okay, sure. So maybe we can just move. So maybe we can just move to next slide. Yeah. So these are some points maybe we would have already touched upon, but I'll quickly go through. Critically analyze projection, scenario, and sectoral analysis. So as we discuss scenario analysis, we need to broadly see what scenario we're falling into and then choose one set of projection rather than taking multiple probabilistic projections. And sectoral analysis is very much required. We need to bucket our company which we're valuing into which sector it is falling to and whether upside, downside, or neutral we need to see. And changed operational and market conditions. So this is little tricky as we saw in the market conditions. Really, we cannot assess much except to conclude that I mean the situation is not as bad as what we see. So yeah, that's about it. Risk adjustment in cash flow doesn't mean pessimistic. So risk adjustments we discussed as to we need to split the cash flows into say near future and little later and then the far later thing. But we need not be pessimistic because that is one thing many people will have. Let us be as conservative as possible so that we are not we will not be in trouble later. But we should not adopt that because valuation is not to be as conservative as possible. Valuation is to be as closer to reality as possible. So we should be just realistic in assessing and not very conservative and pessimistic. Going concern assumption, yeah, many companies practically has an issue of going concern, except especially the startups. If you feel that there is only 2 months more cash flow is left for the company to continue operating, then definitely unless they show any confident acceptable plan for survival, I don't think there is any way we can go with a pure DCF value without any adjustments to going concern hit. We need to see critically analyze and see how we can adjust the value because they have only 2 months of runway. I don't think anybody will invest unless there are an existing investors can pull in or they themselves has a source in which they can fund the company. Then benchmarking post-recovery period, industry growth, cost estimates, and demand trends. So yeah, so that's what we discussed in a way. This also post-recovery period, what should be the growth rates and anything we need to be clear and benchmark them. Next slide, Ravindra. So discount rates again not to be simply increased. Initially we were thinking should we just add up 2-3% of discount rates because we are in this situation, nothing is clear, but I don't think that is acceptable because for various reasons if we think discount rate as a I mean, what is the meaning of discount rate? Discount rate is an opportunity of return, right? If I'm not investing in this company, what is the best possible investment scenario which I can look at it? So that will be the expected rate of return or discount rate for this company. So even the opportunity, next available opportunity is also similar, having similar risks. So when we are talking about this global crisis which is applicable to all, then the discount rate should not impact too much than what we have seen, point 1. And point 2, we should not do the error of adjusting the discount rate based on the recent market returns. See, generally the way of computing the market return would be the, say, at least an annual average of last 10 year, 20 year, 30 year, whatever period we feel it is relevant. Because if we don't take annual averages of each period, the depending upon, say, if you are valuing, if you are arriving at cost of capital in, say, February, and if you arrive at the cost of capital in, say, now, or maybe say mid of March, where the market saw the bottom, there would be a huge difference in the value. But if you adopt annual averages and then averaging, then this in between short-term upticks or downticks would be taken care. So once we have that, we have a habit of doing say 10, 20, 30, whatever period, but with annual averaging, which would have considered at least two such crises. For example, all this while we were ensuring that 2008 crisis and 1999 crisis was there in our computation of market return. So likewise, if at least two crises are taken care, then we should be good to use the same discount rates and no need to do any adjustments only because of this another crisis. Market-wide and firm-specific risks. Definitely firm-specific risks anyway we take, and we need to maybe see market-wide also. As I said, if they are falling into that sector, then definitely all companies in that few sectors which are prone to this much will be hit. And high volatility impact period. So I don't think much emphasis should be given on this point. I mean, definitely if there is when there is a high volatility, the same should be considered adequately in discount rates, which would have already been factored into. So no specific thing to be looked into for this scenario. So long historical period, as I told, 10 to 20 years anyway, if we are considering for market risk and risk-free returns, then 2-3 recessionary cycles would have been considered. That should be good enough. And forward-looking approach, this is very important. So like I was saying in the first point, as we know that discount rate is the next available opportunity, another angle to be looked into, it has to be a forward-looking approach and not what has been in the past. For example, if we take the average of the past, we arrive at a one rate of discount, and say if we are valuing this in a situation where we are in the third phase already. So in such scenario, whatever we do adjustments and derive the backward looking rate of return, in future it may be completely different. So definitely our approach should be a forward looking approach, but however, because of the lack of information, and I mean every one of us cannot do an holistic assessment, holistic estimation of the forward looking rates, and certainly we need to rely on backward looking whatever historical numbers are there. But we need to be careful that 1.1 because it is a long average, including say 2-3 recessionary cycles are already there in that period what you have considered, we can safely take that to include this to ensure that this situation is already considered. But however, apart from that, if we really feel, depending upon the date of our valuation and everything and what transpires in the next 1-2 months, we may need to revisit our discount rates because it is not forward looking. I mean to say, if we are already there next 1 or 2 months, we need to revisit whether existing CAPM discount rate we should take or any specific adjustment to be done. But for now, I don't think there is any issue. We should continue to do whatever discount rates we follow. Survey method, mostly for startups, we also use this. As I was saying, we value a startup at a very early stage without even considering much, as long as basic sanities of who are the promoters, what is the business model, whether they're there in replicable businesses or not. Once we see those basic things, even without having projections, we can bucket them as I say 1 million company, 2 million company, like that. So that is an accepted method as long as some sanities are taken care. So when we are doing such kind of methods, we need to have the right survey or right sample. Why we are saying it's a 1 million company, what all number of other companies which we have seen, we have the list. So those things to be taken care. Next slide, Ravindra. Yeah. So, okay, this also we again discussed earlier when there is probabilities. First is we should try staying away from probabilities, but if we are doing it for any reason, then scenario probabilities to be done, and option pricing method can also be considered rather than just putting some probability number of 30%, 40%. If required, we should even consider option pricing instead of a mere probability. And even though we are not doing, we are not considering probable different projections for discounting it, we could at least do sensitivity analysis. It would help the reader see for a regulatory driven report. Sensitive analysis would not be relevant because regulators would just need to see one number. But if we are doing valuation for any transaction or for any other reason, sensitivity analysis would be a good add-on, since we would have considered only one projection without any probabilities. Sensitivity analysis with one lower and higher probabilities would really make our report very good. But this may not be applicable for regulatory driven reports, because regulators would just want to know what is your final value without irrespective of other sensitivity we have done or not. Then some disclosures which I touched upon a little bit earlier. So long-term impact valuation adjustments, what we already saw, the long-term what we would have done, the specific disclosures we need to make both for long-term as well as short-term. What could be in our assessment the impact on the valuation and the space as such. And subjectivity in inputs, whatever inputs we have considered slightly more disclosure than normal to say, since we have not changed any inputs as of now, for example, discount rate or additional risk premium or DLOC or DLOM, if we have not changed anything because to address this situation, maybe a line of explanation as to why we have not changed. For example, we discussed on DLOM, there were two views. So our view, what we are thinking, maybe we should explicitly disclose in the report, apart from just saying what we used to say earlier. Say DLOM, we used to say value as judgment so and so percent based on some transactions we have seen. Maybe we would have told like that. Now we should add on saying that, and also there is no change in our experience because we don't see that this issue would be a much more dampening issue per se. And valuation uncertainty. So as I told earlier, there should be one section where we talk about the possible uncertainty, because we don't know whether we may reach the third situation or not. If we reach, that uncertainty is there, we would need to make a disclosure of that.
So quickly, I just trying to understand, if we don't take an alpha and you say that the discount rate is going to factor in your ups and downs, say for example, we take a market risk which is for a 15 or 20 year period, it would have taken the ups and downs. So what I am doing a valuation in the current scenario is absolutely no different from a valuation I would have done 2 months back, right? What is the extra bit of risk that the person is going to take up, right? Come out as a high risk rate, right?
Yeah, so actually when the person is actual investor with a long-term horizon, there is no additional risk which he or she is taking. Only possible minor additional risk is just in case of the third scenario comes off, what we will do. So that's maybe the only
that is
risk.
a probability which is an absolute worst case scenario, which might turn out, which might not turn out.
Yes,
that is a
yes.
two-way possibility that might happen or might not happen. But
Yes.
the aspect of it is that don't you think valuations will be questions on the factor that how is it that you have an optimistic viewpoint?
I understand, madam.
How have you not addressed it, no?
Yeah, I understood. So what I was saying, there are two factors. One is that minor possibility of reaching out there. And another point is, so if we are reaching that situation, then there may not be too much value for money also. If I don't invest and keep money, there may not be too much value for money also. Anyway, if we are reaching such kind of a scenario, there is no value for I mean, definitely no value, or maybe a large depreciation in the value for money itself. So anyway, by not investing also, I'm not achieving much.
Correct,
and also the other thing is one more important point. One more important point is the fear of missing out an investment will be a lot higher than earlier now, because that is another very important. As a promoter and as a valuer, we may not be able to too much appreciate that fact. But however, as an investor, the fear of missing out is that will also have a lot of cost. Because already, because of the slowdown and stoppage of economy, their returns have already gone down in terms of time. So they may not be able to, any rational buyer would not be in a position to lose out even this possible opportunity. So having said this, anyway, valuation will slightly come down because of the fact that in our projections, there is an adjustment for this period. And all our cash flows would have been deferred by a year or so. So because of this reason, anyway, valuation would come down. And to the extent how much it comes down, I think it would have, I mean, it should take care of the risk what we are talking about.
So let me try to understand. The only two aspects that would move the valuation would be the market risk, which I would have factored, and the fact that I'm being conservative on my projection. Is that the only two things that would actually move my value?
Not conservative on the projections. I mean, to just address the real situation.
Yeah, I understand. But yeah, of course, my outlook would have been a month earlier will definitely not be the same the current month, right? It would have there would be a shift in terms of how I would want to project.
Yes. So that would factor in because of the time value, as I told.
Let me try to understand if those are the only two items that would move my valuation. So what kind of concern addressing I would do in my valuation report by just talking about a COVID? It is just that I have factored the fact that there is been COVID and I am not blind to it. Is that what be the reporting that would come out?
And not only that, we have also made our calls, as we discussed earlier. Our outlook is based on how the sectoral movement changes. That we have another call we have taken. For example, as I was telling, if I'm in the restaurant industry, I have taken a call that there will be little different in behavior, the way people go and dine out. So because of that, I've changed my projection. So that is some call I've taken. And say another call would be the real situation itself, like the three situations what we discussed: quick retraction, slow retraction. So that again another call I've taken because we are not considering probabilistics. There again another value or judgment I've made, saying that saying I don't expect this to go beyond 2-3 months stoppage of economic activity, and say 2 to 3 years in which economic recovery will happen. So these are all the judgments we have taken. For these, we need to have disclosures.
Okay, so you mean to say you outline specifically how you have addressed it by saying that this is all you have taken care of it. This so you take comfort in the value.
Yes.
But somehow I have a little difficulty digesting that whole thing. Though
yes,
it
madam,
makes
even
logical sense to it, I would definitely give an alpha to the economic aspect, which would take a little more time than normalcy to return back to where we are.
Yes, madam. Even we had a lot of
that upswing
issue.
is gone, right?
No, the thing is, even we had a lot of issues like this. But from one perspective, please think, madam, we are seeing a value erosion in one company which we are valuing. But always value is based on compared to what, right? So if the entire economy has gone down, then my company going down is not an issue at all. If entire globe is into contradiction and entire all other companies are also going down.
It would purely be on sectoral impact alone. If the way I actually see it is that, then that means what I'm basically doing is just adjusting my projections or postponing the cash flow. That's all I'll be doing.
Yes, that's all we'll be doing, plus the sectoral adjustments, if any.
Okay, I think I'll take a little while to digest that aspect because I was always of the opinion that we need to have an alpha for the pandemic. At least the economic activity where there is a slowdown, you have applied a brake. It's going to take a while before you apply the gears to accelerate.
Yeah. However,
but have you not considered even in for example, leave out the last case, aviation or any other industry, and leave out the essentials because those are not going to see any kind of adjustment. The middle bit, which is like a commercial real estate or any other form which falls into the mid category, where you would see activity, but not immediately. It would take another month, a year or slow for that recovery to happen to where we are today. So in those kind of things, have you never considered an alpha and you thought this would be enough?
In some cases, it makes sense to consider. For example, if we don't have a clarity on, again, I'm going to the example of, say, restaurant, because it is very clear. There now, as of now, I don't have a clue as to what could be the behavior of the consumers after once everything is recovered, or even a fashion industry or a mall, anything. So we don't have clarity as to how it may turn out to be. So, so accordingly, if I classify that it may have much larger impact than other sectors, then I would do an adjustment for alpha. Again, that is coming back to my sectoral thing only.
Okay. So it would be a call whether where you don't know exactly how it's going to pan out. Then you say that there might be, it makes sense probably to consider an alpha.
Yes, and also many other cases also will be there where an alpha can be considered. For example, as I was giving the example of say next 3 months only the company can run, and within that they need to do one fundraise, means I have a lot more risk than normally I would have thought. Otherwise, I would not have thought that to be too risky. 3 to 6 months, if it is there, it is quite normal for companies to raise funds as long as their other things are intact, other business model is intact. Now it will be a little more riskier. Or if there is or in case of their I have a scenario where in the company, for example, Jubilant, the company which is there in Nanjangud, if such kind of a companies which I'm valuing may not be that big, but just as an example I'm giving, definitely a lot things will hamper and a lot more alpha is required than that. So if there is any specific impact other than generic to the company which we are valuing in any way, then definitely slightly more alpha than what we used earlier should be required. If it is generic impact, which impact is there on any other company, then no need to add alpha.
Okay, fair enough. Okay, thank you.
Okay, maybe we can move to the next slide, Ravindra. Ravindra, should already we have exceeded the 1 o'clock was the time. Should we continue? I am okay to continue for 10 more minutes.
Yeah, will conclude fast.
Sure. So in market approach, maybe I will just try to skip market approach. Anyway, slides will be there. We can go through and then try to reach the conclusion slide. Maybe we can go forward, Ravindra. But one important point which I want to highlight in market approach, which I touched based earlier, when we are taking the comparable multiples, whether in internal comparable or in external market comparable, whatever comparables we are taking, we need to be conscious as to what was the situation when we are taking the transaction multiple at that time, say a year ago transaction or 6 months ago, 3 months ago transaction, which we are taking as comparable, and how we are applying that to our situation. The basic numbers on which we are applying, say the EBITDA or turnover or whatever we are applying, if we are applying to an affected number, that means if we are taking the transaction comparable transaction of a pre-COVID and I'm applying on the numbers of post-COVID, I need to be careful. I don't have a ready answer as to what we need to do, because it depends upon 2-3 scenarios whether this is a acceptable numbers for the going forward, or there'll be much more change in the numbers. We'll not have much clue. Maybe we need to take a judgmental call as to how do we adjust for this factor. So other than that, I don't think in multiples approach anything much I had to discuss. So maybe we can go to the conclusion slide after 2 slides, I think. Next slide. Yeah, so this also to an extent we discussed, but just to summarize, if we are doing the pre-impact period valuation, then no adjustments in valuation, and short-term corrections status quo assumption, because it is a pre-COVID scenario, and long-term corrections, since uncertainty is there as on the valuation date, if it is there, we need to be accordingly done, otherwise no. And disclosures in the report is compulsory. We need to make the disclosures, even though the valuation date is pre-COVID, as the report date is today, we need to do disclosure. And impact and recovery, impact stage, or we are in the recovery stage, then as we told, sectoral analysis and scenarios, we need to consider which scenario we feel is the right out of the 3 scenarios. And then evident long-term correction, if we feel that long-term correction will be there for a longer term, valuation adjustments accordingly. And any other adjustments in discount rate or anything, I don't think any other adjustment required. Then report disclosures, we already discussed in detail. A specific disclosure should be there for COVID, and also broken down into each of the assumptions and input what we have taken and how we are disclosing that. So last sentence, we need to avoid bias. Adjustments or disclosures should be based on generic market expectation and not individual beliefs. Everybody, we all would have some kind of, even it was very difficult for me to digest the fact that how there can't be increased risk when I'm seeing risk everywhere. So likewise, we may have a lot of things. We may feel that say malls will get affected because I'm very scared now to step out of my house, so I don't think malls will function. So likewise, we should be very careful if I'm making my own judgmental things into the thing. We need to see how generally everybody are thinking around and then try to apply. Though this is applicable always, I think now we'll be a lot more biased than earlier because we will have all our own things and thought processes. So we need to be a little careful whether we are going ahead with that or we are having any other.
One more question, in case of, have you seen any, have you for academic interest tried to analyze the valuation post and pre-COVID, whatever that you had undertaken in December and what you would have set the value today? Have you ever done, that exercise?
I've not done it, but definitely a lot of changes will be there, mostly because of projections.
Okay.
Because
The
projections
projection
would
is
go
the only way you
drastically.
would say. Okay.
Yeah, and also other than that, also maybe after bifurcating into the sector, if that is not an advantageous sector, I would have increased alpha suitably.
Okay. All right. But projections are given by the management. So how do you actually bring it out through a disclosure saying that you are making an adjustment? So you would be called up for why you're making that, no?
No, we see, as I was saying earlier, we need to take a call on what we feel as the outlook, which three buckets we are falling into. And when will, say, lockdown, complete breakdown of the economy and recovery, when will those factors in our judgment is right? Say 3 months could be the blockage of activity, 1 year 2 years could be the recovery period. So we will decide that. And then see and measure whether the projections provided the management is in line. If there is, if they feel that in next 6 months complete recovery would be there, then it should be very difficult to accept that. We need to convince them saying that definitely it is not possible to, you show the situation of 2008 and earlier situations where how much time it took to recover and all, and then push them to change it. If they are not changing, actually practically if they're not changing, it's very difficult to go ahead with. It is better to get them changed and see both of us will reach a situation where it is acceptable to us. But if you're in a situation where they don't want to change and if you want to go ahead, definitely a disclosure is required in the valuation report, and the difference is too much, then we should increase the cost of capital with alpha.
The thing is, if there is a situation where the management is not willing to change the projections in accordance to the valuer's anticipation of the future, would it not mean that the risks related to the cash flows are more? The reason being, risk is basically when is a measure of expectations not being met. Now, if the valuer feels that the risk, that the expectations are that the expectations of the management is not the same as that of the valuer, it means that the valuer is perceiving that the cash flows are a bit more risky. When the valuer feels that the cash flows are a bit more risky, then would it not be a good idea for the valuer to take a higher discount rate? Now, how is it that the valuer would be able to justify that higher discount rate is up to the valuer?
I just said the same thing. If management are not agreeing, two things we need to make. One is disclosure in the report saying that we feel the projections are not a lot more optimistic than what we feel the reality could be. That disclosure, and additionally, alpha increase in alpha is possible. But as you said, two things: how do we justify one, and how do we justify the right number? Whether 1% increase is good for the change in projection, or 2%, 3%. That could be very difficult to explain, but it is a valuer's judgment and valuer's call. We need to maybe go to the drawing board and then just see what some story or some theory what we can build in, and for our benefit in future, just to ensure that we are not forgot as to on what basis we have done that. We should have our own theory as to why we did and how much percentage, why we did that percentage. And I think that's about it. Maybe I would hear with others also here if on this point, because it is very judgmental call and there is no other possibilities there. And this is there always, not only crisis situation, always it is there. I mean, even otherwise also management may not agree with our thought process.
In fact, I would like to add a small point here. In fact, in the long run, many of the professional circles have now come up with an idea that, when compared to Chinese, we have a very good advantage now. So in the long run, maybe India stands good in the matter of trust, in the matter of health, health sector. So many worldwide, even India could be a health tourism also could be encouraged. Manufacturing from India will be encouraged all over the world. So how are we going to consider all that positive effects in the long run? If we are feeling so pessimistic now, how are we going to consider it? That definitely is an added advantage to India when compared to China, right?
That's a very good point, madam. Actually, Chinmay basically pointed it out. Correct me if I'm wrong, Chinmay. That we'll have to overcome the bias and have to have a justifiable reason. There are lots of theories which are going around about economy picking up in such period, such not period, and on so on. So basically, we'll have to come above that. That's where we differentiate ourselves from any other profession. I mean, that's why we are valuers. So we'll have to come above that bias, is what Chinmay rightly pointed out, is what I feel.
Correct, agreed.
And also these are a lot more world macroeconomics. For example, Shilpa, I don't differentiate with your view. Definitely, I agree with your view. But however, also looking at for a recent example, when the US-China trade war was happening in the last 1-2 years, I don't see any sectors in India booming because of which, even though the opportunity is there, I don't see we have taken advantage of it. Not only from government perspective, was there any push? I don't see any push, any discussion or anywhere, any schemes or any push to the industry to go forward and represent there in US to replace any of the Chinese contemporaries or something. Nor from industry also. For example, I don't see, maybe that would have happened, but say a Reliance or an Adani or Vedanta or anybody going and talking them and representing there, I don't see that happening. So, but I still agree with your point that there may be positives also, there may be negatives also, both are possible.
We need to basically wait for justifiable evidence. I mean, corroborative evidence before we take any changes. For example, the recent FEMA change which happened, that is something which we can put it in our perspective. I mean, that if one of the contenders to a particular transaction is a entity which shares the borders with India, then probably there we might have to increase a bit of discount, because that makes the transaction a bit more difficult to consummate. So that is something which we need to do. There should be a corroborative evidence rather than just a bias.
Yeah. I think it's time to conclude, Chinmay.
Sure, I'm done.
Anybody has?
Regarding as to what we need to do with respect to valuation reports which have a valuation date prior to COVID era, I suggest we refer to the ICA valuation standard, which talks about subsequent events. ICA valuation standard 201, which paragraphs 36 to paragraphs 36 to 39. I mean, those are most relevant paragraphs. Unfortunately, I was not able to see a comparable discussion in international valuation standards, but this is something which has definitely been addressed in the ICA valuation standards, standard number 201.
Sure.
Thanks, Chinmay. That was a very wonderful session. You took us through the complete scenarios, COVID scenarios, how the industries are getting impacted, and pre-COVID, current, and post-COVID. And also you took us through all the markets, different markets, how they are behaving, and particularly investors, how they are behaving and how their stocks are behaving. And you gave some lot of positive signs, nothing to lose, like when compared to 2008, we are all little at comfort stage at this point of time. But also you gave us how the mood of investors is there in the COVID era, like you gave us so many investments which have happened without any taking hit of this COVID impact. That also shows the positive signs. And also how each approach will get impacted in the COVID. That was also beautifully told, and what might be reporting obligations for us. So I think from this, we all have got an idea how we can proceed on our valuation assignments. Thank you so much for that. And I wish to, especially thank from Bangalore Valuers Association for giving your time to us, and also all the participants who participated in this program. Thanks for it. And tomorrow also we are going to have one more webinar where we are going to discuss valuation in disputes in terms of in the background of disputes, how the valuation will happen. Expert in dispute resolution, Mr. Mrinal, is going to take us through that. Tomorrow we are going to have that in the morning 9:30. I'm going to share the link with all of you.
Sir, is it possible for us to use a medium other than Zoom? I mean, if it means that we'll have to subscribe to anything, then probably we can moot out that idea. But some of us...
Even I don't mind subscribing, because I tried out with the Zoho. It was not very comfortable. And even with Abram sir, we tried to do Google Meet, our first meet. Even there we had a breakdown. So if anything good is there, we don't mind going.
Ravi, we have new app, Namaste. It is competitor to Zoom. Maybe we can use. Today we are using that app, okay, in our meeting. We'll update you like how that app is working.
Yeah. If it is good with this comfort of Zoom, I think we should move on. Couple of them had put it in a group that they don't want to participate because we are operating out of Zoom and they don't want to give their user IDs to Chinese servers.
See, one thing is there, this Namaste, how confident we are that it is not a Chinese one.
Yeah.
See, we are just getting carried away. Namaste bol diya to it is a Indian app. Chalo lago sab log. That is a more dangerous app.
Should we not try Skype business? Although I mean, it does require a subscription since we have a value association in place.
Correct. What I understand, there's a concern as Home Ministry says that Zoom is having Chinese server. Now, when Home Ministry says that, that means there is a lot of government documents which are being shared across in these meetings. If they want to avoid that, for their staff right from top to bottom, they will definitely say this is to be with caution. Now we have to collectively find out what is the next possible alternative till that time, or till anybody is not infected or having a serious problem. We should try to continue. Ours is an educative program and no sensitive data is being shared during these meetings as well.
Sir, the thing is till day before yesterday, or I mean, I might have experienced it just now. Till yesterday, day before yesterday, it was not asking for me for a login. I don't know,
that is asking for any app, anything you download, because it is a legal requirement of the police. The police tomorrow, if anything illegal takes place on a platform, the platform company is held liable for showing that who all had done. It doesn't mean that they are accessing your email account to hack it and then to send emails from there. They just want to ensure that you are an authentic person certified by Google.
Okay.
See, legally, earlier days when you used to go to cyber cafe, that fellow used to say, keep your identity card outside, then enter inside. Similarly, any meeting room we go, whether we go to Avaya Spaces, whether we go to Skype, whether we go to Zoom, identity will be required to be authenticated by one of these email accounts or mobile accounts.
Appreciate that.
So let us have that knowledge. If anybody is having anywhere a real case कि my system was hacked and the data was stolen or somebody has intruded, then okay, then we should immediately raise that, put a police FIR that this is a Zoom meeting app, this should be banned all over India. Rather than sending the directive, simply lock it. Tomorrow if a TV channel makes some mistake, we have got all the right to complain to them, and then there's a close it altogether.
Sir, probably the issue is that with respect to these free apps, right? The general understanding is that when the app is free, when a product is free, then we have to understand that we are those products. So that's the only apprehension, I guess.
The thing is, a newcomer will always come with a negative publicity, and when Ministry of Home Affairs is concerned, any platform, whether it is Zoom, Skype, or any platform, they should not be sharing any of their meetings. Today we are into a situation which is exactly like a war. Every country, every state, every city has to keep an alert watch what is being shared through these forums. So let us see whether today what platform we are having is having a good connectivity. Our program, even if recorded, is not having any data which will be detrimental to the security of the country, and neither our laptops.
No, it's only in terms of our accounts getting hacked or it going to our bank accounts, something like that. That's the only worry. Otherwise,
till now, if there is single proven case and we file a police FIR that my account was hacked, we have to see, whenever a new system comes, such type of things always come up.
It is not necessarily a question of your account getting hacked. Whatever is the recording of the entire session sitting on some server in China and somebody accessing that. So there can be damage without your account may not be hacked, but still you can be damaged.
Yeah, this is the concern.
Yeah.
This is the concern, and this concern I am saying is correct.
Yeah.
But for this concern.
But when you're saying that show me any one single account, any person's PC has been hacked or something, damage need not be dependent upon anyone's PC being hacked, because the recording of the entire thing would be sitting on some server and they'll access from that server without hacking your PC.
So the only request is, would it not be a good idea for us to go with a tested and known service provider rather than a new unknown service provider in such testing times? That's the only concern.
Exactly. So somebody says namaste. It may not be an Indian app.
I mean, I'm not talking about namaste. Probably something like WebEx.
Even Indian flags are made in China.
Something like Skype Business, WebEx, Cisco WebEx. These are some of those options which we can explore, I guess.
How good is their clarity and quality? Because Zoom has not come yesterday or today. They have also invested servers everywhere, and they are also under the watchful eyes of Indian government. There was a big issue about BlackBerry servers 7-8 years back, and later on BlackBerry has agreed to install a server in India and share their data with the ministry, Indian ministry.
I think Avinash Tripathi lost the connection. Shall we close the meeting, and tomorrow we'll see which platform we can consider.
We can close it.
Yeah.
Sure. From my end, thank you very much, Ravindra, and also thank you everybody for a wonderful participation. It was very good to talk to all of you. Thank you.
Yeah, it was indeed a wonderful session, Chinmay. Thanks a lot.
Thank you.
Thank you.
In between, my connection was lost.